Hello and welcome to Outlook Money podcast. I'm your host, Ankita Verma. Let's face it, your money really has just three jobs: grow, stay safe, and be ready when you need it. Most of us get one or two of those right, but rarely all three. Today, we are looking at a product that might just tick all those boxes for you, especially if you're looking for short term, low volatility options that don't compromise on safety or access. We are talking about liquid exchange traded funds or liquid ETFs. They promise the trifecta of safety, liquidity, and competitive returns. But how do they actually work? And more importantly, are they the right fit for your portfolio? To answer that, I'm joined by someone who's been in the game long enough to know the ins and outs and everything in between. Chintan Haria, Principal Investment Strategist at ICICI Prudential AMC. Chintan has been with the AMC since 2005 across roles in equity trading, fund management, and now designing ETFs. So, if there's anyone who can help us decode liquid ETFs without jargon overload, it's him. Chintan, welcome to the show. Great to have you.
Thank you so much. Always a pleasure speaking to the listeners of Outlook.
Okay, let's kick off things simple. For someone new to investing, what is an ETF and how does it work?
Sure. So typically, ETF was a word which probably investors were not familiar with, say, 7, 8 years, 9 years back. Probably the only ETF they were familiar with were the likes of, say, Sensex, Nifty, and Gold ETF because they were prevalent in India at that point of time. However, of course, in the last 5, 6 years, especially after COVID, we've seen an expansion of the investor base, both in terms of the money that they've invested in the market and also their knowledge on the market. So the learning curve has been pretty much, and I think Outlook has played a extremely good role in terms of doing all these podcasts with us and explaining in detail everything. We've done a lot on smart beta ETFs as well. So to your question, what is an ETF? To put it simply, like investors have options to invest in the market, right? So you have equity shares which you can buy through your Demat account. You can invest in mutual funds which are actively managed, right? And then an extension of the mutual funds. So mutual funds which are listed on the exchange for investors to buy and sell on the exchange are known as ETFs or exchange traded funds. These are basically instruments which allow investors to participate in the underlying fund through the units which are listed on the stock exchange. So just treated as ETFs are funds which are listed on the exchange where investors can buy and sell them on real-time basis. And that's what probably differentiates them from the other mutual funds which are not listed. That's the only differentiation. And then ETFs can be of various kinds. There can be equity ETFs which have underlying equity as their base. For example, large cap ETFs, mid cap ETFs, small cap ETFs. There can be sectoral ETFs like banking ETF is very prominent, IT ETF is very prominent. Then you have smart beta ETFs like low volatility or momentum are very popular. Alpha low vol is popular. And then you have gold. Silver was launched sometime in January 2022. So gold and silver ETFs are also very popular. And then you have on the debt side, you have ETFs, among which the liquid ETF is the most popular in the ETF space. Thank you.
Right, so essentially, we're talking about a market listed product that's easy to buy and sell as a stock but is structured like a fund, right?
That's
Uh, okay, narrowing it down to what exactly is a liquid ETF? How does it operate and what way is it different from other ETFs in the market?
okay. So as I was mentioning, a liquid ETF is a type of ETF that primarily invests in very safe short-term instruments. When I say very safe, essentially it is the tri-party repo, which is also called TREPS, to put it simply. TREPS in essentially are overnight instruments which are basically guaranteed by the CCIL, which is essentially the Clearing Corporation of India Limited. It basically is the central party. Then there is a person who needs the funds, there's a person who lends. So in this case, whatever money is being uh, put in the liquid ETF, that gets lent to the person who needs to borrow. The borrower can be, say, someone like a bank or a financial institution which needs overnight money. And this is guaranteed by CCIL. So essentially, liquid ETFs are instruments which provide investors a way to invest in a product which is, let's say, extremely safe in terms of its underlying low risk, very highly liquid, which is essentially the TREPs, which I explained, which are basically the settlement of which is guaranteed by the Clearing Corporation of India Limited, which is CCIL. And from an investor standpoint, they should consider it as essentially a way or a vehicle of parking their excess funds. So, for example, if you have money which you sold equity shares and you want to park it for the time being, then the liquid ETF is one of the use cases. If you want to basically keep money parked in an instrument which can easily be utilized for investing in markets at a later date, then also liquid ETFs come in handy. So, liquid ETF in very simple terms is a product which is gaining traction because it allows investors to peacefully park their excess capital in a overnight instrument which is extremely liquid, and also the ease of investing, also the let's say the safety of investing. Everything is there in terms of the liquid ETF, and that's why it's becoming more and more popular for investors who want to temporarily park their money in the liquid ETF. Thank you.
So, in a sense, a low risk, short term parking spot, but still tied to the market.
That's
So,
it's essentially a debt product, right? It's investing in overnight. So yes, it's it's basically let's say a liquid ETF, as the name suggests. It's like the liquid fund, but it is traded on the exchange, and the underlying is tri-party repo, which is essentially a debt product where you get the overnight rates essentially as your return.
so the name liquid is intriguing. Does that mean you can literally pull money out whenever you want, or is there more to that term?
Of course. So, it being a exchange traded instrument, whenever the markets are open, you can buy or sell the liquid ETFs, and the settlement of the liquid ETF happens as far as the exchange settlement trading mechanism is concerned. For example, if the settlement happens on T+1, you will get your money in T+1. So, it is as liquid as most instruments can be in terms of their settlement mechanism.
Okay, let's talk comparisons. Many investors will think this sounds very close to a liquid mutual fund. What's the key differentiator here?
Correct. So they wouldn't be wrong in comparing it because more or less the objective is the same. The use cases may be different because typically liquid mutual funds are used by larger institutions and corporates to park their excess money. Plus the fact that liquid mutual funds have an exit load which a liquid ETF does not have. So that is one key differentiator, that liquid mutual funds, I think up to 7 days, there is an exit load, while in a liquid ETF, there is no exit load. However, more or less the logic remains the same. Liquid ETFs, of course, are traded on the exchange. Liquid mutual funds are not traded on the exchange. For investing in a liquid ETF, because it is on the exchange, you will need a Demat account, while if investing in a liquid mutual fund, you don't need a Demat account. Otherwise, I think from a liquidity standpoint, you do get intraday liquidity which is available from a liquid ETF, while of course the redemption of a liquid mutual fund will happen at the day end NAV. And generally, if we look at from a use case basis, as I had explained a little while earlier, liquid ETFs are, the target audience is essentially those who are active in the equity markets and want, and even the derivative markets for that matter, and want to either park their surplus funds or they need margins against their derivative positions, in which case also a liquid ETF can be utilized with a certain haircut as a margin for their derivative trade. So these are the use cases which liquid ETFs can easily fulfill. While a liquid mutual fund is more or less like a traditional instrument where large corporates and larger investors invest their money which they need for short-term parking.
Okay, so here's a practical hurdle for some investors. The Demat account, is it mandatory for liquid ETF investors?
You need to have a Demat account when you are investing in a liquid ETF. That is mandatory. You cannot otherwise access it. If you do not have a Demat account and you want to park your excess funds, then you need to go the mutual fund route where you can have overnight funds or savings funds or liquid mutual funds for you to invest in. But yes, if you want to invest in a liquid ETF, which generally the use cases are such. So if you are doing derivatives, generally you will have a trading and Demat account. If you're doing equity market share investing, that you'll have a general Demat and trading account. So for the use cases that are there, definitely an investor would have a Demat account in any case. And if you If you see over the last 5 years or so, the number of Demat accounts in India has moved from 5 crore to 19 crore total Demat accounts. In fact, unique Demat account users are about 11 crore in India and above. So there are a lot of Demat account holders in India, and I think it's like a norm right now that anyone who has a financial investment would have a Demat account. So I don't think that's an impediment, but yes, if you want to invest in liquid ETFs, you need to invest in or you need to have a Demat and a trading account. Thank you.
Okay, now if I line this up against familiar options, a saving account or a short term FD, how does a liquid ETF perform on the three big parameters returns, safety, and liquidity?
So if you look at returns, of course, the liquid funds returns are as per the overnight rate. So in very tight monetary situations, the overnight rates can go up. In easy monetary situations, the overnight rate can come down a little, but they're generally in a range. So if we see that the returns in the liquid ETF are linked to the overnight rates in the market in general, savings account are anyways defined by the individual banks based on certain parameters, and if you look at other investment avenues also, it's linked to the markets in some sense in terms of whatever is the RBI rate. But liquid ETFs is essentially with the overnight linked with the overnight rate, which is typically influenced by the day-to-day demand supply of money. Whenever money supply gets tightened, the liquid ETF can give a higher return. When money supply goes down, it can give a lower return. But more or less, I would say it is a good substitute for the use cases which is there. So I wouldn't say that liquid ETF you should look at in comparison with the traditional instrument, but you should look at from a use case basis, wherein the ease of accessing this liquid ETF by selling it on the exchange and being able to use that for buying the equity shares and also the pledging it from a derivative perspective. That's something which makes the liquid ETF a slightly helpful instrument for the use cases that are there. Liquidity, of course, is very high during market hours. I don't think liquidity is a problem, which is also the case with the other two, traditional investments which you mentioned. Maybe in fixed deposits, the liquidity may not be that high, and there may be penalty provisions, etc. if you withdraw early. But otherwise, liquidity-wise, liquidity ETF is reasonably good. And safety-wise, I think all three are similar. I don't think you need to worry about the safety of the instrument, given that it is at least the liquid ETF is backed by this Clearing Corporation of India in terms of the settlement mechanism. The other two, as long as you stick to right underlying offering banks, etc., you should be okay. Thank you.
So essentially, it's about squeezing more of out of your idle cash without jumping up the risk ladder. Let's talk about the portfolio itself. Where is my money actually invested, and how do those holdings generate returns?
Okay, so if we look at typically, as I was explaining earlier, liquid ETF is an instrument which invests in overnight money, and overnight money in the case of India, it used to be called earlier CBLO, which is collateralized lending and borrowing obligation in technical parlance. That has been now called TREPS, which is tri-party repo, right? And what is tri-party repo? As I was explaining, there is a lending institution or there is a lender, like in this case, liquid ETF, because it has excess capital or excess, money. It is the lender. It is lending on that tri-party repo mechanism, wherein there is a borrower on the other side, typically a bank or a financial institution which is in need of short-term money. So a borrower who is in need of short-term money is met with the lender who has excess capital. And CCIL, which is the third party in this entire triangle, is essentially the guarantor of the transaction. And the borrower, which is essentially the financial institution or bank, gives generally government securities as a collateral for the lending which is happening. So it is essentially a lending mechanism which is backed by collateral. So to put it simply from an investor standpoint, it is a safe way of investing, and the underlying investment is essentially the tri-party repo, which is, like I mentioned, literally a safe triangle between the CCIL, the lender, and the borrower, and backed by government securities. And generally, the it is an overnight. So, for example, one day is essentially the transaction all about. So every day this transaction happens. It's a very liquid market, very safe market, and like I said, it's let's say covered with the CCIL as the guarantor to the settlement of the tri-party repo. So Very simply put, your liquid ETF invests in tri-party repo, which is called TREPS, 100% of the money, and that is basically a safe way to get overnight returns, returns equal to overnight rates that are going on in the market at that point of time. Thank you.
How sensitive are these to interest rate movements? Say RBI raises rates sharply. What happens to my liquid ETF there?
So typically, it's an overnight instrument, so I don't think you need to worry about rate sensitivity, right? Because whatever is the changes in rates, you'll immediately get the benefit of that, or the negative aspect of that the next day. So it is overnight money which would not typically get impacted significantly, because generally the interest rate risk is in instruments which have a longer tenure, 3 years, 5 years, 10 years. For an overnight instrument, you don't have to worry too much about the interest rate risk.
So, unlike long term bonds, you are not really taking on the duration risk here, right?
That's correct. That's correct, because the duration is only overnight or one day. So it's not going to have an impact on your, interest rates are not going to have a meaningful impact for you in terms of your long term returns or returns in the liquidity ETF.
Okay. So, if you had to give investors a ballpark, what's the typical return range they should expect from liquid ETFs?
So if you look at the range of overnight rates generally in the last 3-4 years, so it's anywhere in the range of around 5% or so. So 4.5 to 5.25 has been the general range. So while we cannot predict what will happen in the future, generally in the past, that's the rate at which the overnight market has traded, and investors can expect around that, but that's obviously subject to the rates of the overnight market. The past 3 years, 4 years, if we look at it, whatever is the rate or the overnight rate, that's generally been the range, 4.5 to 5.5. It could have moved a little higher than that or lower than that for a very short period of time, but generally that's the range which investors can expect from the liquidity.
Okay, let's get specific about liquidity. If I sell my liquid ETF units today, when will the funds actually hit my account? Same day or T plus one?
T+1 settlement is what essentially happens in India for debt funds, and that's how it will happen in the case of liquid ETF also, because, and like as you know, even for equity stocks on the exchange, so the settlement mechanism has become T+1, and so you'll get your money in T+1 on when you sell the liquidity.
I think that's quick enough to be functional as a cash management tool. And speaking of that, can
Yeah, because essentially whenever whatever you'll be buying today, you'll need the money tomorrow, right? So you need to settle it tomorrow. So by the time you need to settle it, you'll get the money. So that's how it works seamlessly in terms of a very liquid instrument for managing your cash flow needs.
so speaking of cash management, can these be used as a parking space for surplus funds before making a long-term investment?
Yes, absolutely. You can do that as well. It can be as a parking space. It can be as a space where if you basically sold something and you want to temporarily park it, yes, you can temporarily park it pending investment in equity markets for the future. There are many use cases, like I said, possible, and this can be used for temporary parking as well, yes.
I think that flexibility is definitely a win win. Before we wrap, my last question would be about taxation. How liquid ETFs are taxed, and how does this differ from liquid mutual funds?
Okay, so from a taxation perspective in India, liquid ETFs or any debt instrument is basically taxed at the marginal rate as far as the taxation goes, and that's true for the liquid ETF as well. So similar to debt funds, similar to liquid mutual funds, liquid ETFs will be taxed. The gains on liquid ETFs will be taxed at the marginal rate in the hands of the investor.
Okay, so the tax treatment is kind of identical, meaning the choice comes down to liquidity and execution style.
That's correct.
Chintan, thank you so much for joining us today and breaking it all down for us.
It's always a pleasure, and I think it's an instrument which investors should be aware of. And thank you for taking it as a topic of discussion, because generally people would be interested in knowing about many of the equity ETFs, sectoral ETFs, smart beta ETFs, gold, silver. But I think liquid ETFs is also a very important tool for investors to manage their money overall. And so, thank you for taking up this topic. And as always, wishing all investors happy investing and happy Independence Day as well to all your listeners. Thank you so much.
Thank you. And that's Liquid ETFs, safe, accessible, and a smart way to get more out of your short term funds. And to our listeners, thank you for tuning in. We hope you found this episode valuable. Don't forget to subscribe to Outlook Money podcast for more meaningful conversations like this. Until then, stay informed, stay secure, and as always, make your money work harder for you. Thank you.